Good morning and welcome. I'm John Grimsley with Highwoods Properties, your NAIOP Georgia president this year. Welcome to our May meeting. As you see, we have an esteemed group of panelists today, and we look forward to hearing your presentation this morning. As always, we would like to thank our sponsors. Our headline sponsor this year is Majestic Realty Company. Our platinum sponsors, Brassville and Gorey, Fidelity National Title Group, Highwoods Properties, Mayberry Electric, Nelson, Ryan, Troutman Pepper, and Truist. Today I will be highlighting two of our platinum sponsors, Fidelity National Title and Ryan LLC. Fidelity National Title Group is a leading provider of title insurance, technology, and transaction services to the real estate and mortgage industries. FNF is the nation's largest title insurance company through its title insurance underwriters, Fidelity National Title, Chicago Title, Commonwealth Land Title, Alamo Title, and National Title of New York, that collectively issue more title insurance policies than any other title insurance company in the United States. The Atlanta NCS office is a regional hub for commercial services in the Southeast. The Atlanta office is one of the only offices nationally that underwrites for all of their companies. The Atlanta team has the capability to manage any size transaction, as well as the ability to co-insure with the FNF family. The Atlanta office closed over $35 billion in commercial transactions in 2021. Ryan LLC. The Atlanta property tax experts at Ryan have both the deep local expertise and national presence to handle diverse portfolios seamlessly for clients in all the industries. Ryan currently represents $36 billion in assessed value in Georgia. Their talented teams have secured nearly $100 million in tax savings for their clients here locally over the last 3 years. Ryan opened its Atlanta office in 2000 to support its growing portfolio of Georgia clients, and the office has been growing exponentially since. The recent acquisition of Marvin F. Poor added 40-plus professionals to their firm, operating since 1970 in the market. Ryan was named to the 2022 Top Workplaces in Atlanta by the Atlanta Journal-Constitution, and Ryan has been included on this prestigious list 4 times in recent years. Ryan was also named to Fortune magazine's list of the 100 best companies to work for, and has been named to Fortune's Best Workplaces for Diversity and Best Companies in Professional Services list. We truly appreciate the continued support for both of these sponsors, and we are happy to welcome their company representatives who are with us today. Thank you. We also support for NAIOP Georgia and become a sponsor today. Contact our Vice President of Sponsorship, Brandon Houston, or our NAIOP office for sponsorship opportunities. Now on to NAIOP Georgia business. We'd like to thank everyone who attended and supported NAIOP Night. It was truly a great success. It was another sold-out event for nearly 600 people in attendance. Thank you for helping us present a check to our designated charity, the Ron Clark Academy, in the amount of $75,000. Next, registration will be opening for our June meeting, June the 23rd, at the JW Marriott Atlanta Buckhead. This will be our summer casual meeting event, so wear something casual. And we look forward to a great meeting. Now, I'd like to welcome our Vice President of Programs, Amy Curry, to the stage to introduce our moderator, Lance Patterson.
Good morning. I'm excited to introduce our moderator, Lance Patterson, today. Lance is CEO of Patterson Real Estate Advisory Group. Patterson, founded in 2009 by Lance, is a capital placement and real estate finance advisory firm based here in Atlanta. Lance's career spans nearly 40 years in commercial real estate and finance, and we're thrilled to have him here today. So with that, I'll turn it over to Lance.
Great. Thank you, Amy. 40 years, holy cow. Long time. Well, thank you, Amy, and thank you, NAIOP, for having us here to talk about the capital markets. It's an interesting time, for sure. I chatted with quite a few people before the panel this morning, and we're all trying to deal with some issues that are happening right now in our industry. I thought we could start by just very briefly having each of our panelists introduce themselves, tell you what they do and where they do it. So first we have Tuba Malinowski, who's the Chief Operating Officer from Stockbridge, Chris Miller, President of Ackerman and Company, well known obviously to this group, and then Travis Johnson, Investment Director from Principal Life Insurance Company out of Des Moines, Iowa. So Travis came from Des Moines to be with us this morning, so thank you for that. So if we could just spend a minute or so just talking about.
I think half of Stockbridge Atlanta is here, so I will make it super brief. Stockbridge is an investment advisory company. We have about $28 billion under management. We have 3 offices, San Francisco, Atlanta, and Chicago. Super proud to say that our Atlanta office is the most active office over the last 5 years. We started here about 11 years ago and have about 44 people right now. I not only work as our COO, but also as the portfolio manager of our core fund. So a lot of what I talk about today will probably pertain more to our core fund and where we're investing.
Thank you. Chris?
Thanks, Lance. Tuba, that's pretty interesting. I want to hear more about it. As Lance said, I work at Ackerman and Company. I was going to make a joke, but I'll just tell you what Ackerman really is. We've been in business 60 years now. We're a full-service real estate company. We're Atlanta-based, but operate across the Southeast. We do a couple different property types, probably more than we should. We continue to have a brokerage company and do some third-party work too. So we're a bit of a dinosaur, but it's kind of fun being the only dinosaur left. So that's what we do. I guess I'm here today to talk about investments we're making or we're trying to sell in office, industrial, medical office, retail, and some land stuff we're fiddling around with. So I'm happy to be here. I appreciate John and Amy and Lance inviting us, and try to give you some take-home value for your $65 breakfast.
All right, Travis?
You bet. Yeah, as Lance mentioned, I'm an investment director with Principal's debt origination platform. So my comments will be a little bit more geared towards life company debt or the lending environment. But I've been with the company 21 years, really focused on the entire Southeast, mainly Tennessee, Carolinas, and Georgia. Principal itself, so the debt origination platform falls under Principal Global Investors, which is the investment vehicle or arm of Principal Life Insurance Company, and really have kind of 3 channels, the debt side, which I represent, and then also the equity and the asset management side as well. So from the debt perspective, we'll do anywhere from $5 billion to $6 million of production a year, which kind of spans a pretty wide array of lending vehicles, whether it's core mortgages, bridge loans, mezzanine transactions, construction financing, and even some hybrid debt and equity solutions as well.
So what'll be great to hear about from Travis is it's hard to find one lender that is active in traditional long-term permanent debt, fixed rate, construction debt, bridge debt, value add, all of those different types of debt. Principal does and Travis does that, so we're looking forward to it. So as I mentioned, I talked to quite a few of you beforehand, and you're going to hear all sorts of things, I hope, on the panel that'll be interesting, but you're certainly going to hear about some challenges. We're all facing some challenges today. And so I wanted to start by putting that in context, and you're going to have to forgive me and bear with me a little bit, but I'm an avid reader of fiction, and I'm going to read the first few sentences of one of my favorite novels ever. Most of you will recognize what I say, and then we'll see if you know who wrote it. and what the book is, but here it is. It was the best of times, it was the worst of times. It was the age of wisdom, it was the age of foolishness. It was the epoch of belief, it was the epoch of incredulity. It was the season of life, it was the season of darkness. It was the spring of hope, it was the winter of despair. We had everything before us, we had nothing before us. We were all going direct to heaven, we were all going direct the other way. In short, the period was so far like the present period that some of its noisiest authorities insisted on its being received, for good or for evil, in the superlative degree of comparison only. So anybody know who wrote that?
Charles Dickens.
Dickens, all right, so that's A Tale of Two Cities. So I love the line, it was the best of times, it was the worst of times. We are facing some challenges in the industry, and it's easy, I think, to say, boy, these times suck. This is the worst ever. How frequently have we heard, this is the worst time ever? You can apply that to lots of different places in our world today, and I don't think it is. I think we've always gone through this. By the way, he wrote that about the beginning of the French Revolution. So that was in 1789. He wrote it in 1859. But we always kind of think these times are hard. No doubt they are, but we also think there's some good opportunities too. So we're going to try to be positive as well as realistic about what's going on. So with that being the case, our first question, it's been pretty easy the past couple of years to only say positive things about industrial and maybe not have many positive things to say about office. But I'd like to flip it. I'd like to hear us talk about some positive things on office and maybe some challenges in industrial. So Tuba,
I get to go first?
you get to go first.
Okay.
Yeah, why don't you start with
I mean,
that?
I think that ultimately nothing's as good as we think it is, and nothing's as bad as we think it is either, right? So I can, we have some great performing office deals. Actually, Jeff works on one of them. Carriage works down in West Midtown. It's been one of our best performers through, for the last 5 years. Honestly, we, well leased. We've seen great leasing activity. On the flip side, we have some office buildings up in Alpharetta, probably not exactly where you want to be, that have really struggled. So I think as we look as office, and frankly, I could say we have the same experience across the country, they're winners and losers. And I think that we'll talk more about that, and I think that's going to continue over the next, 5 to, 10 years, where you're going to have office buildings that people really, really want to be in. And so they're just going to continue to outperform versus some of the assets that just can't get it going. And so I think those get a lot more of our highlights right now than some of the really well-performing office buildings do. So, and then on the flip side, on industrial, my one negative take is, there is still supply issues. We've all heard about what's happened with Amazon over the last, couple of months or so. I think it's probably understated that they're subleasing 10 million square feet. I think it's probably more than that. But, that will probably slow down the industrial market. There's a fair amount of supply coming on in a lot of our markets. So, it's probably not quite as good as we think, despite the fact that fundamentals are pretty impressive.
So, Chris, I believe Ackerman really turned, among other things, to industrial development 5, 6, 7 years ago. I'm sure you'd always done it, but it seems like it was a heavier focus, and maybe at the same time kind of pulled back a little bit on the office investment side. So what's your view, Ben, on that?
Same question, what's a positive on office and a negative on industrial kind of thing?
Sure.
Yeah, okay. Well, I guess the biggest positive I can think of on office right now is that we've gone through a period where a lot of us, many of us, weren't able to go to work. We still did work, or at least we were supposed to still be doing work. And many of us were, but we couldn't go to work. And I think that the positive, the thing that to me is positive about office is many of us decided we like going to work. We like consuming the product of office space. We don't like working in our basement. We don't like Zoom. We don't like not seeing other people. We don't like, our only work friend being kind of short and hairy and barking. So that's, that now I know everybody, some people still think they want to work remote and some people want to work hybrid and we want all these things, but the best thing that I see about office is there are a lot of people who really are connected to the product and they want to go back and they're looking for office space that's memorable, which to me is not It's not about design, it's not about architecture, it's not about installation of expensive art. Memorable things involve people. So if I want to have a memorable workspace, what that says to me is I want to work with people who stimulate me and make me better. So I think that's my observation about office. And yes, you're right, Lance, we over the last cycle, we did less office. And we did more industrial by quite a bit. And some of that was intentional, and some of that was just the opportunities that presented themselves seemed to be more interesting in medical office and industrial. What's not good about industrial? This is a little tougher because I think that the doom and gloom about the economy right now, it relates to inflation, it relates to capital. It doesn't relate to what's really important. If you only leave with one nugget of information today, leave with this. It's about a broker bringing a tenant to a landlord and signing a lease. And if you lease the building, nothing else matters. And if you don't lease the building, nothing else matters. So right now, the thing that is not negative about industrial is supply and demand are still in pretty good balance. And yes, there's a ton of supply coming on, but we're at a vacancy rate that's so low that you can't even do business. I mean, tenants are literally doing business in tents, in truck courts, because they can't get space fast enough. And that's not by choice. So I think that if I answered Lance's correct question, honestly, I would say if I had to choose a major concern about industrial, it is that it is fairly easy to supply, and we have some supply coming, and there are some markets where that will be unbalanced. And that supply can be new construction, it can be sublease space coming back. If you remember back to the 2000s with not the 2000s, 2000, and some of you are that old, we had the dot-com crash, and we had tenants who had, quote, over-leased space. So you'd go into space, and there was brand new Herman Miller furniture sitting on three floors of space that was supposedly, quote, leased, but it had been leased for 2 years, it hadn't been built out, and the furniture was still sitting there in boxes. Is that happening with industrial? Maybe a little bit. I think that's part of what you're hearing from Amazon. How much? Well, I think that's what Tuba was saying. Is it 10 million that Amazon has for sublease, or is it 10 million in Atlanta they have for sublease? I think it's probably somewhere, it's somewhere in between. It's more than 10 million in the country.
I've heard 10, I've heard 20, I've heard 50, I've heard 100. Who knows?
It's hard to even. I mean, one of the things we're working on right now. And here's we think this business is so easy now. Anybody know how many buildings and how much square feet Amazon occupies in Atlanta? No. Only people who know won't tell you. They're sitting there on top of their space trying to figure it out. So, we're spending time trying to figure that out as a way to understand, well, if they're offering 20% of their space for sublease, well, 20% of what?
So
I don't know. I'll quit rambling.
Yeah, Chris, you said something I want to just comment
No,
on.
you can't follow up. When I say something, that's just a fact. You can't. There are no follow-up questions allowed.
Well, I'm giving you credit for it.
Oh, okay, okay. Well, then it's okay.
It's all good, and I want us to come back to it, but
But let's make sure we
sometimes
include everybody.
I just think it's good to sit back and listen to things and just say to yourself, so industrial, it has been the case your building is probably more valuable without a tenant than with one. Think about that. Just let that sink in for a minute. I'd rather be empty. Really. And Chris says it's all about either you sign the lease and it doesn't matter, or you don't sign the lease. And you all got the implication of when you don't sign the lease, it doesn't matter. I just find, and by the way, it has been true, but when you really think about what that comment is saying, I think it's telling. All right, so Travis,
Yeah.
As a lender.
I think we should come back to that again.
I agree.
Yeah.
Because if you think your building's worth more empty, you're wrong. Lease the building now, because that will end. You will need cash flow, and you will be glad you leased it.
Hallelujah. I love that. All right, so Travis, principal, big lender, investor. Do you know, either now or maybe at its peak, what was the percent of your debt portfolio that was in office?
Yeah, that's a great question. We've seen it trend back over the last couple of years,
What
but
was it at its peak?
it was in the mid-30s, 35% of the portfolio.
35%.
Yeah.
Tuba, what about you? What might have been a
So
peak-ish?
we've only been, the core fund's only been around for 10 years, but I will say Odyssey, which is the big index of core funds, I think was in the 40s, and it's now down to 26. So, I mean, that gives you a good feel for.
Yeah, so I think industry-wide, and it can vary, but we've probably all heard about allocations, and so whether you're equity or debt, you want to have so much in office, so much in retail, industrial, apartments, maybe some hotel, all the different things. You've always wanted that, and maybe let's just say office has historically been 40-ish%. Where would you like it to be right now?
We've been underweight office since we launched. So, I mean, we probably like where we are, which is, I don't know, somewhere, if you count life sciences, somewhere in the 19-20% range.
Okay, so
if you don't count life sciences, closer to 15.
15.
Yeah.
What about you?
Yeah, I would say that's a pretty good estimate, and I gave you an inaccurate number earlier, Lance, but I think what we'd like to see is a flip between industrial and office. Our office portfolio is, probably mid-20s, like you mentioned, and our industrial is just under that, just crossed over the 20% barrier this year. And I think the goal is kind of shift those, over the course of the next couple of years.
So I want you to answer this first question, but I'm going to jump around a little bit because you're hitting on some things that I think are interesting. We talked about this a little in our pre-panel call a week ago, but historically, so office maybe it's been 40%, industrial you probably wanted it to be 40%, and you may have been able to eke your way to double figures maybe.
Right.
That's always kind of how it's been. So everybody always wanted a lot more industrial than they could get because the buildings were maybe all that big, and they cost a little per foot. You just couldn't get capital deployed into industrial the way you wanted. It's always been the case. Seems to be changing. So now your industrial is equal, maybe greater than office.
Yep.
So if you kind of think about it, I remember we helped Chris on a 1 million square foot industrial building 6-7 years ago. We were able to count in Atlanta at that time. That was the 33rd building in Atlanta over 1 million feet. I don't know today, but it's probably 133. And it doesn't cost 50 a foot to build. It costs 90. So
Right.
you're now able to get your allocations better hit in industrial. Is that correct?
Definitely scaled, much larger chunks. We're also larger portfolios as well as we see continued institutional equity buying into that space. So it's definitely allowed us to accelerate that flip from office industrial exposure.
Lance, we've also widened the definition of industrial,
That's
right?
true.
I mean, the whole truck yards, truck
Yeah.
terminals, outdoor storage. I mean, we've really widened the definition.
That's right.
I think that's something else, Tuba, I want you to comment on this,
Okay.
but so the rabid appetite for industrial, which I think is going to continue, but what we've always sort of had, particularly the last couple of years, among other things maybe, has been because investors and lenders were just underallocated in industrial. That's changing. You mentioned that a couple of your clients are kind of full on industrial. When's the last time you heard that, right? So, not to say you don't have other clients who aren't, you're not going to still go after the good deals and all that, but just comment on that a little bit.
Well, I mean, I think if you look at how much industrial's written up, right? I mean, it's been the top performer. So so we've had massive write-ups, and then you counter that with the fact that retail really wrote down a fair amount, during the downturn. I will say that's a great example of it's not as bad as you think it is because retail's been a great performer. Frankly, over the last, we bought a big grocery anchored center, and I know that's not our topic, but it is. You do have to think about the fact that both retail and office have stayed either steady value or written down. So industrial as a percentage does go up just by the write-ups. In addition, I do think that broadening our definition of industrial, buying 1 million square feet as well as a lot of land in the form of storage, has really helped us increase. As an organization, we're about 49% industrial. So that gives you a feel for what percentage of our company is industrial. And I think principals like that too. You guys have historically been, on the equity side, a big industrial player.
They have. When they, this is dating back 50 years, their initial foray in the real estate was industrial. So they're kind of, it's ingrained into their, the fabric of what they do. So yes, yeah. They have. I think from our perspective, we're maybe not there on getting to an exposure concern on industrial, but I think I'm seeing a little bit of an effort to diversify where we are from a warehouse industrial standpoint for a life company. A life company has always been, hey, let's operate, specifically principal in the top 25 MSAs and stay there without deviating at all. And I've seen that shift over the last 18 months, both from the debt and equity side, where markets,
Charleston and Savannah.
yeah,
right?
markets that we ignored for whatever reason, seeing a little bit more focus. The Greenvilles, Charleston, Savannah, those types of things. Just to create a little bit more diversification of the portfolio while we grow it.
Okay, sorry, my mic came up. Put that back on. Okay, so Travis, I'm going to allow you to answer that first question. So what positive things is Principal looking at in office right now?
Yeah, my view from a debt origination standpoint, so I originate the loans, but then I monitor them on an ongoing basis going forward. So when I see office activity, it's usually, after the post-closing, there's an issue with space. A big tenant has left or, created a hole in vacancy. And the one thing I've noticed that's been different this, now, and I view it as a positive, is usually the call comes not, hey, we've got a vacancy, there could be an issue here. It's, hey, we've got a vacancy, but our activity on that space has been reasonable. And there's been some good examples of, backfilling space at rents that were on the original lease and an assignment of the lease, maintain the rent level. And so that surprised me. That's either tenants being more proactive in the sublease market, which has been good, or we've got the right types of office in the portfolio. So I think that's what we're going through now is just identifying, okay, what's the differentiation or differentiating factor on the buildings that are seeing success in backfilling space to those that aren't. But at least across the portfolio, I'm seeing decent activity on releasing or subleasing space.
Okay, good to hear. Chris, you wanted to comment on the topic we were discussing about your building's more valuable empty than with a tenant.
I think I got it in. Pretty much. Look, there are rare periods in the market where things are true that shouldn't be true, and generally they're created by the stampede effect of capital trying to turn real estate into things that it's not, or use it as a speculative instrument that really don't need to have that risk. And the comment I was going to make is just look. Having done this, how many times have we done this in the last 5 cycles? Mm-hmm. There are very, very rare times where you are tempted to asset manage your buildings to match what is currently being demanded by the capital markets. And one would be, well, I don't want to sign this lease. I want to go ahead and bring it to market with more vacancy. And in our experience, that has been, despite the fact that it works sometimes, it's a very bad idea. Run the real estate as real estate. Make real estate decisions, and the capital markets issues will sort themselves out. And overall, you will be much more profitable in the long run doing what's right for the real estate, and you'll also have way less angst. I mean, imagine how it feels to pass on that lease or 2 leases and then be in best and final and have 3 people drop out, because, I don't know, their investment committee decided that we're not going to have any more industrial this month or something. Whereas if you had the leases, somebody'd step up. There's always someone who will buy cash flow, is our experience. But,
I think especially now, given the environment, speed to make decisions and act is so important. And take the good thing that's in front of you instead of wait for the better one that you think may be coming. Anyway, so let's shift to underwriting metrics, which is a question not just for debt, equity, development, all of those. How has that changed? We'll start this time, Travis, with you. When you're looking at an office deal, and regardless of whether you're looking at construction loan, bridge loan,
Sure.
permanent loan, how's your underwriting today versus, say, pre-COVID and then even a year ago?
Yeah, on office deals specifically,
Office, yeah.
Mm-hmm. I think, the obvious ones are, we've probably increased our static vacancy underwriting, going forward. Definitely put a little bit more focus on having the right level of tenant improvement estimates, as we, forecast rollover. things like that. And then we actually go through, because of the maybe pressure on cap rates and values, almost a simulation of a moderate recession, where we take each asset, plug it in and allow TIs to increase, leasing commissions, et cetera, and then also move cap rates, really probably 75 to 100 basis points, and see how that property performs, or that loan specifically, under that type of stress. And if it holds up, the nice thing is it's not like we've paused on office lending. We still want to get office product out, just as we said, keep that balance, but it's just finding the more durable office assets and what those are and putting them through that stress test.
So is there a permanent loan that you would not make today that you might have made a couple of years ago on an office?
On an office deal, anything near-term roll would be, a immediate, deal killer. You hear the term WALT. Yes, it is. That's the number one discussion point we have when we're reviewing, office transactions. But I would almost say there's more focus when we're reviewing office deals on, I think you mentioned it, what would make this office building successful. It used to be parking focused, things like that. I think that's changed a little bit to, okay, how functional is the building from, flexibility, ESG components, but then also, amenities, making sure people want to come into that space. And I don't mean amenities, the cafe or the fitness center in the building, but around the property, finding those locations. So it's a combination of WALT and the actual, really digging into the real estate.
Can you, most of the, maybe everybody knows, but just give us the real quick definition of ESG, and how important is that to you right now?
Yeah, so it's environmental, social, and governance, and it's definitely it's something we all track through LEED certification, things like that over the years. But from a lending standpoint, it was maybe a check the box. Nobody really tracked it. Today we're monitoring every investment that comes in for ESG components, and checking that and monitoring again, making sure our portfolio is increasing from exposure or investment in
so
those types
if a particular property doesn't check all those boxes or any of them, is it a straight away can't do it? Or?
Not today, no, but I feel like it's heading more that
It's
direction.
heading that way. Okay.
Right now it's more gathering data and understanding what we have and what we can build from. So not a negative by any means, but the other direction could certainly be a positive.
Too, but just on ESG, is that a big focus right now?
It is. It's a very big focus for our organization. I think that it's really something that the clients require. We have a fair amount of European and Australian clients. They were always ahead, so we'd gotten surveys from them for years, but I will say that the US clients have also started asking a lot more questions about ESG, and so we made it a real push.
Can you don't need to name them, but just what is a client for you?
Our primary client base is US or foreign public pension plans.
Right.
In the case of Australia, it would be a sovereign wealth plan. Okay. So, for example, the Southern Company would be one of our clients, okay. Or,
So these investors, it's very important to them. Consequently, it's very important to you, and consequently, it's going to become very important to all of us if it's not already. But it kind of reminds me of the early stages of LEED, which is what, mid-90s, kind of maybe, late 90s. And boy, I remember when it first came out, you felt like, holy cow, man, if your building's not LEED, you'll never get it'll never work. It had to be LEED, and then it was important and cool, but it didn't really ever get to that. You had to have it, or the world's going to end phase. ESG feels a little different to me. Does it feel different to you?
I think part of it is that it's these companies have pressure on them too, right? Mm-hmm. So the tenants have pressure on them, or the clients have pressure on them. So it's an easy way for them to check boxes.
Well, maybe if we have a few minutes at the end, we can talk about what you need to do to check those boxes. And besides just, we all know an environmental, well, actually we may not know what that means. We know the words.
I think that's part of the reason that your sense is it feels different than LEED is it's not clearly articulated criteria. Mm-hmm. I mean, I have 25 different equity partners. I bet I've got at least 22 definitions of what checks the ESG box. Right. And you've got people who are doing it because they were told to, And then you have people like university endowments who literally will accept a lower return for an investment that meets more of what they fundamentally believe is really ESG. Right. Now, it's not 50 basis points lower, but 25. You know, I mean, this is something I want. So, my guess is that part of the reason you're feeling uncertain about what that is that nobody's made any effort to agree on what that is. Everybody's just kind of like decided, well, this is ESG for me.
So
and that's
big,
going to shake out.
Sort of blob moving forward for sure, different pace and direction and all that, but it is coming, and if you're not familiar with it, it does feel quite a bit different than LEED, and it feels like that's going to be a important issue and it's important by itself, but just in terms of how you capitalize your project.
Right, totally separate from your individual position of, should we change the climate and whatever. If you're a sponsor and you don't have some ability to address those issues, you're going to lose money. So I'd start reading. or lose money, maybe that's your preference.
Okay, so Tuba, underwriting, and not just what you put into the computer model, it could be that, but also you mentioned you may have some assets in Alpharetta that aren't doing so well. Carriage Works, which is creative, cool, all this, doing pretty good. So talk about if you were to look at a new office investment, what might be exciting, what's not going to be, and how do you see all that shifting?
I mean, I'll be completely honest, we haven't bought an office building in 2 years, right? We haven't actually bought an office building since, right before COVID. So we did close on one asset that's more of a value development type asset in Charlotte. That we had tied up pre-COVID, but we haven't purchased another one since then. So that's I'll keep that on the side. But we do value our assets on a quarterly basis, so we spend a lot of time with valuations and where we think value should be. What would be really exciting to us is certainly I agree with Travis in the case of especially an office, we want credit tenants. And we'd like to have some longevity in the credit tenants lease. We have, certain markets that we really like, and I think that was one of the things we talked about in the call is what kind of markets do you like? And I think a lot of our decisions are going to be market specific and sub-market specific. For example, in Charlotte, we love the South End. We have a great performing asset in South End. I don't think I'd look at downtown Charlotte. Right, so it's going to really be more market specific. And then as far as underwriting goes, I agree. No outsized rent growth, 50 basis point, differential between your entry cap rate and your exit cap rate. Just kind of going. I think industrial's gotten really aggressive, as has multifamily on our underwriting. We haven't gotten aggressive like that in office. So there's not that much of a pullback or a change that I'm worried about. It's just kind of looking at it asset on an asset by asset basis, looking at the historical vacancy. To Chris's point, is it an asset that people want to come to, right? And whether it's the people that are there, the amenities that are around it, the general surrounding area, I think all of our decisions on offices are just really on an asset by asset basis. Whereas on industrial, we can make more of a broad market decision, right? We like industrial, and we can go out there and buy it. And in some cases, we do put some outsized growth in there because you've seen it in the market rents.
Right.
We bought an office building in December. Now, it's not a traditional office building, but there are people who go to the office there. And what did we look for?
We're going to know.
And what's interesting is credit, Walt, that didn't get any of that. It's a 220,000 square foot adaptive reuse office on the Beltline. And it was leased at the time by Sony Pictures for $5 a foot as kind of a master lease to make movies at and stuff. And we got 20 acres. No, we got 12 acres. And we paid $20 million. And we got 6 months of weighted average lease term. And our thought process there was, we like the land. Fundamentally, if Sony doesn't work out, someone else will want to come here. And they may want to come here as creative office. Mm-hmm. They may want to come here as in-town distribution. It was originally built as an industrial building. I wouldn't say it's a great one, or they may want to come here if we tear everything down and build multifamily. So our thinking was in buying it was that there were a number of different ways that we could make money and make it work. And it seemed to us that so long as we did not over-lever it or do something stupid and had the ability to hold it, through a loss of the tenant and a lease up if we had to, that it would be an asset that would work out for us. And so far what's happened is Sony was at 5, we renewed them at 9, and we're not sure what's going to happen. We think that there's some chance that they'll be willing to sign a long-term lease, which now studios are starting to do in Atlanta or in Georgia. They're starting to feel like, okay, this tax credit thing is permanent. Maybe I can make a longer-term commitment. But we're still very much toying with the idea of break it up, and half of it's already built out for, creative office, lease that and go that way. And what brought us into this, just like Tube was talking about her Carriage Works project, we own Lee and White that's half a mile up the street, and we had a sense of kind of like, okay, where are rental rates? What will people do? Do people really want to come here? So it office for us right now, and I'm not talking about medical office, which we would look at differently and are doing a couple of now. Regular office, I think it comes down to what's your competitive advantage going to be? Because the risk in office is there may not be enough tenants for everyone. So are you going to be someone who gets tenants, right? Or are you going to be, kind of the fourth on the tour list, never really gets the pitch? And I think you have to be memorable. You have to have something that's better about you than other office. But that can be a lot of different things. I think there are a lot of different things that people can want in office. So I'm not down on office. I think that both retail and office right now, I think, have very interesting investment opportunities because their pricing hasn't been blown through the roof. I mean, if you can buy an industrial building that has 10 years of WALT at a 4 cap, I think you pretty much put a ceiling on how good things are going to be. The tenant's not going to call you back and say, hey, I want to pay a little more rent the next 8 years. But if you buy even not a grocery anchored, but a well-positioned retail center, we did this last year and closed this in October. I'd love to do this again. Going in at an 8 cap on a center that was well leased. Yeah, the anchor was Goodwill, but hey, everybody needs a place to shop. Nothing wrong with, actually they have good credit. We had about 5 years of WALT, but it was sitting on a piece of land that I think if we can get to the land, we can double our value just by redeveloping as townhomes. So I think there are a lot of opportunities in both office and retail if you think creatively and really look at the property. What is the land?
All right, I like it. The best of times, right there.
There you go.
Best of
Always.
So we've got maybe 10-ish minutes left, I think. Let's spend a little more time on industrial. And so Travis, you will do construction lending. You've got an industrial deal that comes in the door. Would you do that spec today? If you like the deal? You
would, yeah.
And where does that underwrite to you today? And has that changed at all in the last year?
For us, there has been a change. Well, from a construction standpoint, yes. Speculative lending on warehouse is probably as easy as it's been historically, today. For us, and there's really no, I would say, pause on that. There's some other factors in being a life company on whether I'm competitive on that today, which are unrelated to the industrial or warehouse market, but certainly an appetite there. From, what was the second part of your question, Lance?
Has your underwriting changed in the last year?
Asset specific or property specific? No. I think the thesis is still, given the digital footprint of that space, warehouse and industrial, long-term performance, maybe just cautious approach, to maybe some deacceleration. So maybe a little more focus on what type of rent growth we're projecting. Every sign says strong, but there are a few things we're maybe tempering that back a little bit. But that would be the only minor change.
Tuba is an equity investor owner. How about you?
Same. I would say exactly the same. Probably 6 months ago, we would have put in bigger growth rates than we will today. But I mean, we've seen a lot of lease comps with huge rent growth, right? And I mean, in our portfolio itself, whether it's in Raleigh or Southern California, we've seen, not Nashville, we've seen 30% rent bumps from tenants. So when you see that, it's very hard not to underwrite some rent growth.
It's better to be empty. Let's just not.
I will agree with Chris. That does give me a ton of anxiety. I was in the in Southern California touring, and there are a lot of cranes in the Inland Empire, which is probably the healthiest market in the country. Well, I mean, everything's pretty healthy. But I was like, hey, how much of this is pre-leased? And they're like, oh no, you'd be really stupid to pre-lease it right now, because if you went to your investment committee pre-leased, and 6 months later your rent's going to be up 30%. That really worried me, and I came back, and my team knows I came back. I'm like, oh my God, it's a bubble. How can you think that way? So I do think that thought process is probably dissipating over the last 6 weeks.
Okay, that makes sense.
I concur. You've helped us with some debt.
Right.
I think we've underwritten 5 new industrial builds in the last 6 months, and we probably have 2 or 3 more to close. We've held pretty firm at 63 to 65% loan to cost, non-recourse or carry only. SOFR plus 225, a point up front, half a point up front. And maybe that lack of change on debt is just an indication that we've never pushed that hard on debt. We've kind of been okay. On equity, the people who want to, there are perhaps a few people less who want to do industrial, but the ones who want to make equity investments in industrial haven't really moved their return expectations north. They've maybe moved them back a little bit and said, send us the real numbers, or we're really not interested in seeing a 25 IRR on the stretch case. We'd like to actually see a 14 on the base, a real base case or something. So we haven't seen much movement, but I can tell you that we do see a lot of value in in sourcing debt and even occasionally equity through professionals like Lance's company, and we've used you pretty much exclusively. And the value we see, even if we could do it ourselves, is we get a lot more market information. When Lance comes back to us, and I don't know, you probably do a quarter. We do half inside or 2/3 inside, and you guys, Todd helps us with the rest. You see a lot more market information. Lance can tell you benefit from basically 6 auctions all of a sudden. So I think if you are sensing that your underwriting numbers are moving on your debt or your equity, what our go-to in that case would be to hire a professional and run a full auction and see if that's true. Because the fact that there were 5 people at the same terms 6 months ago, and now there are 2, that doesn't mean the market's moved. It just means you need help finding those 2, but you need to know that. So
something
that's how we're dealing with underwriting uncertainty, is just getting help.
Okay. Something that is forcing underwriting to adjust interest rates. We could have spent the whole panel on how that is impacting underwriting, I think. It's a really, really big deal right now in ways that you may not immediately think are. But so let's just spend our final few minutes. Let's talk about the current interest rate environment. I'm not going to ask anybody to project where you think rates will be, but how are you responding to that, Travis, and how is it forcing borrowers to respond as well, both floating and fixed?
Yeah. It's an interesting dynamic for us as a life company, because as interest rates have risen, a lot of times we've seen spreads contract, but there's been constant pressure for the last 60, 90 days for spreads to continue to widen out, and I actually don't see that settling down in the near term. And the reason I say that is, most life insurance companies, in principle specifically, are relative value investors. So they're looking at the option of flowing capital into corporate bonds or mortgages. And usually mortgages have been the 7, 8, 9 years, because the margin over corporate bonds has been at the widest point. It's now at the narrowest point it has been in probably the last decade, which, why is it happening? Well, it tells me there's still enough, I should be moving spreads out more, but there's still enough demand to put debt product out that it's keeping, as you said, running the process, keeping me honest in terms of where the spreads are. But there is pressure, I think, that eventually you see everybody, continue to move, which then creates another offset of underwriting pressure on, we all have different regulatory requirements that we have to monitor and adjust to, and those increased rates just put more pressure on those dynamics. So it makes, I guess, wrapping up, long story short, the lower leverage, I don't want to say all cash. I need debt and borrowers to have a job, so I don't want to say all cash, but it definitely moves it to a very, from a positive leverage environment to a more low leverage scenario.
Okay, so Tuba, from an equity investor standpoint, it's sort of a double hit. Number one, leverage may be less, and it's being governed now for the first time in 13 years by debt coverage ratios. It's no longer loan to value. It's actually, holy cow, I'm triggering a debt service coverage test. I haven't had that in 13 years, all right? So proceeds are less, and by the way, your rate's higher. Neither of which is good for returns on equity, but how do you look at that?
I mean, I'll be honest, we've bought everything we've bought this year, and we've been very active. We've not put debt on. So it's just been one of those environments where we're trying to figure out what's going to happen. There is enough equity in the market to be able to be an all-cash borrower. So I think we really think it's a competitive advantage, and we've won some bids because of that. So we'll look. We recently have looked at some of our multifamily to put debt on, but for the most part, we've not. I mean, we're buying at pretty low cap rates, right? I mean, if you're a core buyer, you're buying at a low cap rate. To your point, it's very hard to look at that. You see where the spreads have widened to, you see where rates are, and it's not going to be accretive for at least the first couple of years, and it's only accretive later if you put in some pretty significant growth.
Right.
So if you have a 30% recession scenario, suddenly you're actually, if you can, you're better off holding it all cash. Not that I'm trying to get you out of business there, but I mean, I do think that, I do think it's one of those things that we have to look at, when
Well,
we've
so
got
I've
equity.
taken away, I need to have Tuba adopt me because she's got all this cash. And,
Nowhere to put it.
well, no, we need to hire Travis because he won't have a job. So,
Exactly, we got it down.
oh, cool.
I like that.
All right, Chris, comment on that, and then I should have asked if we had questions. I think we're getting close to the end of the time, but interest rates, how is that impacting how you're looking at things?
We see interest rates as a temporary impact on our underwriting, much as Tuba does. I think that the reason that spreads aren't widening is because buyers think that the corpus part of the real estate bond has an inflation hedge, and you're going to get paid back. You're not going to get paid back face. You're going to get paid back face plus. So we don't think that inflation and interest rates are going to go through the roof and stay there. If you do think that, don't do anything. Don't change your underwriting. Just stay in cash until you can, or go to something that is an immediately repriced asset like a hotel. Our view is that inflation and interest rates are going to bump up, but it shouldn't really change which properties you like and which you don't. And if the debt isn't accretive, then just use all cash. And you could always put on debt later if you change your mind and you want to do it, and, or do it at a level where you're maybe impacted less. Not a great answer, but that's what we're doing.
No, thank you. Anybody have a question? Should have asked earlier. And where did Debbie go? Well, how are we doing on time?
We're already over.
There you go. All right. Well,
That's the hook.
thank you, everybody. Tuba.
Thank you.
Great, but if not, thank you.
Yeah. Anybody have a?
No questions.
Doesn't look like it. Well, they just answered everything perfectly. Well, again, thank you, Tuba, Chris, Travis.
You just had-
Thank you, Lance, Travis, Tuba, and Chris. What an excellent program this morning. We're beginning our second year of our Diversity and Inclusion NAIOP internship program this summer, which will officially begin in June. We're happy that we have a few of our interns here today, jumping into the group to this association and ready to learn. We welcome you and look forward to getting to know you this summer. We're also proud of our NAIOP Future Leaders program for 2022. One of the benefits of being a future leader is meeting with our esteemed panelists in a meeting after the meeting where they will discuss everything from the topic at hand to career advice. Today, the meeting is going to be held in this ballroom, so we ask for convenience that the audience exit the room as quickly as possible, and you are welcome to continue your networking in the pre-function area. So real quickly, thank you again to our sponsors, a headline sponsor, Majestic Realty Company, our platinum sponsors, Brassville and Glory, Fidelity National Title Group, Highwoods Properties, Mayberry Electric, Nelson, Ryan, Troutman Pepper, and Truist. We look forward to seeing you at our June meeting. We stand adjourned. Thank you.